What is a strategic investor or strategic acquirer? So what I want to address is, who are they, what do they want, and how do they do it? So who are they? In the realm of entrepreneurial funding, that is venture funding, when you have an early stage venture that is on a growth path, that is scalable, has a repeatable business model, you will attract the attention of outside investors. Angel investors and venture capitalists, generally they only invest in a startup venture because they believe in the future they'll be able to sell that interest for more money. And the idea is they will give them money, they'll burn all that money, as they say, the burn rate. They'll burn all that money on growth. And once they grow, they may not be profitable. Usually they are not profitable. They're still sustaining losses because they have such a large user base, amount of revenue, that type of thing. They're highly valuable. Okay. And the investor believes that they are going to be able to sell their interest later to another party who wants to invest in it. And a later party will either want to invest in it for one of two reasons. Either they believe that they are going to receive a dividend from the company, that is, they're going to hold the ownership and they're going to receive a percentage of profits or whatever is declared as a dividend or some distribution of the profits of the company. But another group are the strategic investors or the strategic acquirers. These individuals do not look primarily to receive a financial profit from the operations of the business. Rather, they are acquiring an ownership interest in the prospective business for strategic reasons. Or there are synergies that occur between the operations of the investing company and the acquired company or the company that they're acquiring an interest in. Now, how do they do this? If they outright acquire the company, just buy it wholesale, the way Microsoft was famous for just buying out smaller startup ventures, then they have control of that venture. They can operate it as a subsidiary unit. They can consume it into the larger entity and just make certain that the operations from that business gel well with what the overall company is doing. They use that brand recognition, the marketplace, their competitive position in the market, brand awareness, their existing customer base, all of that to improve the operations of the acquiring company. If they don't acquire complete or total control, they don't just outright acquire the company, they just purchase an ownership interest in it, they are generally seeking to secure board rights, some level of control over the company through positions on the board or appointing the executive that they desire as head of the company. And the company stays separate, but there is a very close relationship between the acquiring company and the startup venture, the acquired company, and they work together in concert through exclusive dealing relationships or through vendor-supplier relationships. This also often happens strategically as part of the alignment of the supply chain. That is, they call it vertical integration, where you actually own the various portions of the supply chain, whether it's those supplying you or those distributing the product or service that you create or offer. So this is generally how that works. The strategic investor, the strategic acquirer, looks to see what the startup venture does and says, we're focused less on turning a profit on their efforts. We simply need their efforts to bolster what we already do. And so thereby we will translate the value that they generate into value for our company to make it more valuable or to facilitate our current product offerings, service offerings, things of that nature. So that's what a strategic investor or strategic acquirer is and why financial return is not their primary consideration.